In the autumn of 1997, in a glass-walled room in Greenwich, Connecticut, a small group of traders raised their glasses to something almost no one on Wall Street had ever managed. 4 straight years without a single losing quarter. On that whiteboard behind them was a single hand-drawn line, climbing steadily upward for 4 straight years. The kind of line every trader on Wall Street dreamed of drawing, and almost none of them ever actually could. What almost no one in that room could see yet was that the very same year of their proudest toast was already planting the seeds of the fastest, strangest collapse Wall Street had witnessed in a generation. I have spent months digging through financial archives and half-forgotten history to bring you stories like this one, because how markets actually break tells you more about your own investing than any headline ever will. You do not need to watch every frame to follow along. This plays just as well while you are driving, running, or working out at the gym. This is the story of long-term capital management, the hedge fund built by 2 future Nobel Prize winners and one of the most respected bond traders alive. And by the end, we will separate exactly what is proven from what has only ever been legend. To understand how a room this confident ended up needing a rescue from almost every major bank on Wall Street, we have to go back 6 years earlier to a very different, far less celebratory room. In the 1980s, on the trading floor of Salomon Brothers, one name was spoken with more respect than almost any other: John Meriwether, the head of the firm's bond arbitrage desk, a quiet man who almost never raised his voice and almost never lost money. For years, his small arbitrage desk quietly generated a share of the firm's profits so large that colleagues joked the rest of Salomon Brothers existed mainly to support it. Meriwether liked to describe what his desk did not as gambling, but as arithmetic, finding tiny, almost invisible mispricings between securities that should have been priced identically and patiently waiting for the market to correct itself. It bred a culture of supreme, sometimes reckless confidence, a trading floor where the highest compliment was being called fearless and the sharpest insult was being called careful. That confidence eventually curdled. In 1991, a trader on Meriwether's own desk was caught submitting false bids to corner a treasury bond auction, breaking rules meant to keep the government's own borrowing honest. When regulators uncovered it, the scandal tore through Salomon Brothers, and even though Meriwether himself was never accused of ordering it, he was found to have known about it and waited too long to report it up the chain. Within weeks, Meriwether resigned, paid a personal fine, and walked away from the firm and the floor that had made his name, humiliated in front of the entire industry that had once envied him. Rather than disappear, Meriwether made himself a private promise. He would build something no scandal, no regulator, and no single reckless subordinate could ever threaten again. A fund built entirely on rigorous, provable mathematics. He began quietly recruiting the sharpest minds he could find, starting with 2 academics whose theoretical work on pricing risk was already being spoken of as Nobel Prize material. Myron Scholes and Robert Merton had spent their careers building the mathematics behind how modern markets price risk itself, work so influential it would soon win them economics' highest prize. Alongside them came David Mullins, who had, until recently, served as vice chair of the Federal Reserve itself, lending the new venture a kind of institutional credibility no hedge fund had ever assembled before. By the time the roster was complete, the new firm's partners held between them decades of Wall Street trading experience, 2 future Nobel laureates, and a former central banker, a collection of credentials the financial press had never seen, assembled under one roof. In February of 1994, long-term capital management opened its doors in Greenwich, Connecticut, with just over $1 billion raised from banks, wealthy individuals, and university endowments who wanted a piece of what this room promised. A short walk from that same office, a small family diner had already been serving coffee to the town for years. long before anyone outside Greenwich had ever heard of the fund moving in up the street. Within months, sharply dressed men and women from up the street had become regulars at her counter, ordering coffee before dawn and talking in a clipped, confident shorthand she never quite understood. Her teenage son, wiping down the same counter after school, found himself fascinated by their calm, unshakable confidence, certain that whatever they were doing up the street must be the smartest work in the world. What the fund actually did was built on a simple idea. Somewhere in the market, two things that should be worth almost exactly the same amount were briefly priced differently, and sooner or later, that gap would close. Buy the slightly cheaper one, sell the slightly more expensive one, and simply wait, patiently, for the market to notice its own small mistake and correct it. Even the diner owner, without ever hearing the word arbitrage, understood the idea instinctively. She priced her pies to match the bakery 2 streets over, and if her price ever drifted too far from theirs, her regulars simply stopped buying. The gaps the fund traded on were nowhere near as obvious as 2 pies. They were often a fraction of a percent, invisible to almost anyone, which is exactly why almost no one else could do what this room did. To turn a gap that small into real money, the fund borrowed enormous sums against its own capital, so that even a tiny, nearly certain movement could be multiplied into a serious profit. By the end of its first few years, for every dollar of its own money, the fund had borrowed roughly 30 more, a scale of leverage that turned modest, careful bets into a fortune, so long as nothing ever went badly wrong all at once. In its first year alone, the fund returned nearly 1/5 of its capital to investors, then more than 2/5 the year after that, numbers so far beyond ordinary Wall Street performance that money began arriving faster than the partners could even find places to put it. Meriwether is often remembered for a single line, that his desk never gambled, it only did arithmetic, a phrase that captured exactly how this room saw itself: careful, provable, almost incapable of being wrong. The fund kept its exact position secret, even from most of its own investors, and that secrecy, combined with results no one else could match, quickly turned a private hedge fund into a Wall Street legend. Success this loud never stays secret for long. Within 2 years, other banks and hedge funds noticed the same tiny gaps the fund traded on and began quietly placing nearly identical bets of their own. The more people who chased the same tiny mispricing, the faster that mispricing closed, which meant the fund's original, most reliable trades were slowly becoming less profitable with every passing month. Rather than slow down, the fund expanded into new kinds of trades, further from its original bond expertise, into stock volatility, mortgage securities, and government debt from countries far beyond the United States. Every major bank on Wall Street wanted a piece of the relationship, competing to lend the fund money on increasingly generous terms, each one certain that a firm this careful could never actually default. Business up the street had never been better, and down at the diner, business followed right along with it, the counter now crowded most mornings with the same confident regulars. Old enough now to work full-time, her son took a teller's job at a small local bank, hoping the steady wage might one day become a foothold on the same ladder his diner customers had already climbed. In the autumn of 1997, the Royal Swedish Academy announced that Myron Scholes and Robert Merton would share that year's Nobel Prize in economics for the very same option pricing formula the fund had built its machine around. Financial journalists, who had spent years speculating about the fund's secretive methods, now had an irresistible headline: a hedge fund quite literally run by Nobel laureates. By every outward measure, the fund had reached the absolute peak of financial prestige, celebrated mathematics, celebrated returns, and a reputation that made its partners feel, for a little while, almost untouchable. At the very height of that confidence, the partners made a decision that seemed to prove how sure of themselves they truly were. They returned a large share of outside investors' money, believing there were simply not enough good opportunities left to justify managing so much capital. It read at the time as remarkable discipline, handing money back rather than chasing growth for its own sake. What almost no one outside the room noticed was that returning outside capital while keeping the fund's borrowing the same quietly made its own leverage even more extreme. The fund's own risk models suggested that a loss severe enough to threaten its survival should happen, statistically, somewhere around once in every 10,000 years of trading. At least one junior risk analyst inside the fund privately worried that the model's confidence rested on markets always behaving the way they had in the recent past. A worry raised quietly, and just as quietly set aside. Down at the diner, none of this registered at all. The regulars kept arriving before dawn. The coffee kept pouring, and the son kept counting bills at the bank 2 blocks over, still certain the smartest work in the world was happening just up the street. Thousands of miles away, in markets the fund had only recently begun trading in, the first tremors of a much larger problem were already stirring. Tremors almost no one in Greenwich yet took seriously. Around this same time, a quiet older man began appearing now and then at the diner counter in the early mornings. A leather ledger always tucked under one arm, never saying much, watching everything. Nobody at the diner could quite remember exactly when he had started coming in, only that he always seemed to be there on the mornings that mattered most, though no one could have said why at the time. By May of 1998, the fund posted its first genuinely uncomfortable monthly loss, a small crack in 4 years of an otherwise flawless record. June was worse still. The fund's steepest single monthly loss to date, enough to erode several $100 million of capital in a matter of weeks. Even so, the partners reassured themselves and their lenders that this was simply a temporary dip, the kind their models had always predicted the market would eventually correct. It was, after all, exactly the pattern the fund had profited from for 4 straight years, a temporary dislocation followed by a confident, well-timed recovery. At the diner, business carried on exactly as it always had, the regulars still arriving before dawn, still ordering coffee in the same clipped, confident shorthand as always. The machine this room had built was, in its own way, a genuine marvel of modern mathematics. What none of its architects had fully priced in was a question far older than any formula. What happens when the past stops predicting the future? On the 17th of August, 1998, the Russian government did something its own creditors had long assumed it never would. It defaulted on its own domestic debt and devalued its currency the very same day. The shock rippled outward within hours, and investors everywhere did the one thing the fund's models had never been built to handle gracefully. They panicked, all at once, in the same direction. Investors call this a flight to quality. Everyone rushed at once to sell anything that felt remotely risky, and rushed just as hard to buy anything that felt perfectly, boringly safe. That was precisely, cruelly backward from what the fund's entire strategy depended on. The expensive, safe assets it had sold got even more expensive, and the cheap, riskier assets it owned got even cheaper, the gap widening instead of closing. Worse still, dozens of the fund's separate trades, scattered across bonds, currencies, and stock volatility, trades the models had always treated as safely unrelated to one another, all began losing money at exactly the same moment. The entire safety of the fund's strategy had rested on the assumption that its many different bets would never all go wrong at once. In a genuine global panic, that assumption simply stopped being true. By the last week of August, the fund was losing what had once taken it months to earn in a single afternoon, and the losses showed no sign of slowing down. The partners who had once celebrated 4 flawless years now found themselves awake at 3 in the morning, phones pressed to their ears, watching fortunes they had spent decades building shrink by the hour. Word of the fund's trouble began quietly spreading among rival trading desks, who, through years of doing business together, had a rough sense of which positions the fund was likely to be holding. Some of those rivals began deliberately trading against positions they believed the fund was desperate to unwind, a genuinely disputed practice that made a bad situation measurably worse, whether or not it was ever truly coordinated. The very reputation that had once made the fund untouchable, everyone on Wall Street, knowing roughly how it thought and where its money likely sat, now made it one of the easiest targets on the entire street. Down at the diner, the regulars started arriving later, staying shorter, and talking less, their once relaxed shorthand replaced by clipped, distracted phone calls taken standing up between bites. Her son noticed it too. The same confident faces, now pale and hollow-eyed. And for the first time, he found himself wondering whether the smartest work in the world was actually as safe as it had always looked from behind the counter. Meriwether spent the first weeks of September on the phone almost constantly, quietly approaching wealthy investors and sovereign wealth funds, hoping fresh capital might buy the fund enough time to let its trades finally turn around. Almost every call ended the same polite, quiet way. Interested, perhaps, but not now. Not at this price. Not with this much uncertainty still hanging over the fund's books. What almost no one outside a small circle of bankers fully understood yet was just how large the fund's borrowed positions truly were. Larger, in total, than the capital of several of the banks that had lent to it. If the fund collapsed outright and was forced to sell everything it owned at once into a market already in a panic, no one could confidently say how far the damage might spread beyond it. By the third week of September, the fund's capital, which had stood near $4.5 billion at the start of the year, had fallen to only a few $100 million, a collapse of well over 90% in a matter of weeks. Because so much of what the fund controlled was borrowed rather than owned, that same collapse in capital meant its effective leverage, the ratio of debt to its own remaining money, had become almost unimaginably extreme. By the time the third week of September arrived, the room that had once toasted 4 flawless years was no longer asking whether it could keep growing. It was asking whether it would still exist by the following Monday. On the morning of September the 23rd, a fax arrived at the fund's office from an unlikely trio, the investor, Warren Buffett, working together with Goldman Sachs, and the insurer, AIG. The offer would buy out the fund's portfolio entirely and inject fresh billions of new capital to keep the positions running, but it valued the partners' own stake at a small fraction of what it had once been worth. There was a catch. The offer came with a deadline of only about 1 hour, and it required Meriwether himself to step aside from running the fund he had built. The fund's own legal structure required every partner's agreement before a deal like this could be accepted, a safeguard built for careful decisions, never designed for a 1-hour ultimatum. Before every signature could be gathered, the hour ran out, and the offer expired exactly as promised, unaccepted, not entirely by choice. That same morning, a very different meeting was already being quietly arranged, several blocks away, inside the Federal Reserve Bank of New York. William McDonough, president of the New York Fed, had spent the previous 2 days quietly telephoning the heads of the fund's largest lenders, asking them to gather that same afternoon on the 10th floor. McDonough was careful from the very first minute to make one thing plain. No public money would be spent in this room. Whatever happened next would be paid for entirely by the banks sitting at that table. The reason the banks listened at all was self-interest as much as civic duty. Nearly every institution in that room had lent money to the fund, and an uncontrolled collapse threatened to drag several of their own balance sheets down with it. Near one of the tall windows, A quiet older man stood slightly apart from the table, a leather ledger tucked under one arm, watching the room the way he always seemed to watch rooms like this one. Not every bank agreed to participate. Two firms, Bear Stearns and Credit Agricole, declined to contribute, a decision that would follow Bear Stearns in particular into an uncomfortable reputation a decade later. Federal Reserve Chairman Alan Greenspan did not attend the room himself, but stayed closely informed throughout the day, later testifying to Congress about just how close the financial system had come to a genuine systemic crisis. What followed inside the 10th floor room was hours of difficult, occasionally tense negotiation, each bank arguing over exactly how much of the rescue it should be expected to shoulder. Down a nearby hallway, Meriwether himself waited, no longer at the head of any table. For the first time in his career, simply a man hoping other people would decide to save what he had built. By 6 that evening, a figure had finally been agreed. 14 banks and brokerage firms would together contribute roughly $3.6 billion in exchange for 90% ownership of whatever remained of the fund. The fund's original partners were allowed to keep a small 10% sliver of ownership, but by the time their own personal debts were settled, that sliver amounted to almost nothing at all. Back in Greenwich, the diner had quietly become a waiting room of its own. Regulars sat over cold coffee for hours at a time, watching the fund's building through the window for any sign of what was happening inside. The diner owner herself found herself glancing up the street more often than she wiped down the counter, unable to say exactly why she cared so much about people who had never once asked her name. When word finally reached the diner that a deal had been struck, the mood inside was not celebration, only a long, tired exhale, the kind of relief that arrives too exhausted to feel like victory. The room at the Fed had done exactly what it set out to do. It kept one hedge fund's collapse from becoming everyone's collapse. What it could not do was give the people who built the machine back the confidence they had walked in with. Under the consortium's control, the fund's remaining positions were carefully, patiently unwound over the following year, no longer chasing new opportunities, only closing out what already existed. As global markets slowly calmed through the winter, many of the very trades that had nearly destroyed the fund began, quietly and belatedly, to move back in the direction its models had always predicted. By the time the fund was fully wound down in the year 2000, every one of the 14 rescuing banks had recovered its money, and most walked away with a modest profit for the trouble. The fund's own founding partners were not nearly so fortunate. Many had invested the overwhelming majority of their personal wealth directly into the fund and lost almost all of it. Up the street, the diner kept its doors open exactly as it always had, its regulars gradually thinning out as the fund's employees scattered to new firms across the industry. Her son, now several years into his own career at the local bank, quietly turned down an offer to interview at a larger Wall Street firm that same year, telling his mother he had seen up close what the smartest room in the world could still get wrong. Meriwether himself was not finished with Wall Street. The following year, he launched a new fund using many of the same underlying strategies, but this time borrowing far less against every dollar he raised. For nearly a decade, that new fund performed steadily and unremarkably, exactly the kind of quiet, careful success its founder had once dismissed as beneath him. Then, in the credit crisis of 2008, the same underlying vulnerabilities resurfaced across nearly every corner of Wall Street, and Meriwether's new fund, despite its lower leverage, lost nearly half its value within 18 months. By the summer of 2009, that fund closed its doors as well, an unmistakable, almost poetic echo of the very collapse he had spent a decade trying to make sure could never happen to him again. Today, the mathematics this fund pioneered sits quietly underneath enormous portions of how modern markets price risk every single day, a legacy far larger and far more permanent than the fund itself ever was. We promised at the start of this episode to separate what actually happened from what has only ever been legend. Here is that promise, kept. Start with the version of this story people repeat most often, that the government bailed the fund out with taxpayer money. It did not. Every single dollar in that room came from 14 private banks protecting their own exposure, not from any public fund. Was the mathematics simply wrong? Not exactly. The formulas worked precisely as designed under normal conditions. Their real blind spot was assuming markets would always stay liquid enough to trade, even during a genuine, once-in-a-generation panic. Was this reckless gambling? Most of the individual bets were, on their own, genuinely careful and modest. The true danger was never any single trade. It was piling enough borrowed money on top of many modest trades at once that even a small shared mistake became catastrophic. Did everyone connected to this story lose money? No. The rescuing banks eventually profited modestly. It was the fund's own founding partners, the men whose names were on the door, who lost nearly everything they had personally put in. Was refusing Warren Buffett's offer simple, stubborn pride? That is not entirely fair either. Accepting it would have required unanimous agreement from partners scattered across time zones, gathered inside a single impossible hour, a structural failure as much as a personal one. Was this simply one unrepeatable failure? Meriwether's own second fund, built specifically to avoid this exact mistake, still closed a decade later during an eerily similar crisis, a genuinely uncomfortable echo worth sitting with. Finally, did the wider financial world truly learn this lesson for good? That is still being argued today. Many of the same tools, heavy borrowing, tightly correlated bets, and supreme confidence in a model reappeared again in the much larger crisis of 2008. That is the full ledger on long-term capital management, as honestly as this series can tell it, proven fact laid directly beside the parts that remain genuinely, permanently open to argument. Robert turns back through the ledger's older pages one more time. A young forger's white paper, a stubborn banker's ransom demand, a currency trader's bet, a weekend the banks nearly did not survive, a paper weapon dropped into a mountain lake, each chapter this series has told so far. He writes a single line, steady and unhurried, the way he always does, whatever the chapter, however hard it was to live through. He closes the ledger gently, the gold coin still resting on its cover, and sits back, unhurried, watchful, waiting for whatever chapter comes next. For just a moment, he looks up, calm and unreadable, before turning back toward the candle. We keep making this series because stories like this one get flattened into simple genius or simple foolishness far too easily. The full ledger is almost always more complicated and more human than the legend that survives it. So here is a question worth sitting with. If you were certain your own careful math was right, how many warning signs would it take before you actually stopped and changed course? Tell us honestly in the comments. If stories like this one, where brilliant people build something almost perfect and still get blindsided by what their own numbers could not see, change the way you think about risk in your own investing, subscribing costs, nothing, and means the next chapter finds you the moment it is ready. This series tells real history for general education and entertainment, drawing on documented sources and clearly marking where honest disagreement still exists among historians and economists. It is not financial advice, and it is not offered as the final word on anyone's character. Next in this season, we leave Wall Street behind for a country that broke the same promise about its own money again and again for nearly 100 years, and ask why a nation would keep making a mistake it already knew the ending to. Until then, the ledger stays closed, the candle stays lit, and the next chapter waits exactly where it always does. Thank you for spending this chapter with the ledger. We will see you in the next one.